So I want to know, as somebody who's been in the industry for so long, how do you manage the market cycle of going down and coming back up and not letting it affect your personal life and also your work life as well?
The emotional journey of our relationship with money, the emotional, you just spoke about the emotional journey as an investor, and I think that's a journey it brings solitude, and that's quite personal, and you'll find your ways. I have full confidence that I think knowing you as a person, but also I don't think it's for everyone. For example, that's why I think most people should invest passively and through the index and grow with the whole economy. If you're a doctor, that's like the best example. Again, Peter Lynch talked about this. He said, doctors are horrible investors. He specifically named this because you're smart. If you're a brain surgeon, he talked about doctors who are they went to school and they're so highly technical, they're very smart, right? And then they obviously have high income. Mm-hmm. And again, this is not generalization, but and if it is offended anyone in the medical profession out there, then go to Peter Lynch, not me. But because he talked about this and I learned. But he's saying, but they think they're smart, so they can learn everything. But what happens is that because they're smart in one field, then they assume they can quickly apply that to another field. Stephen Hawking has this quote of the biggest enemy to knowledge is not ignorance, it's the illusion of knowledge. So they think they know. And then generally, the amount of homework that requires to be a full-time professional investor, it takes a full-time job. And I have this analogy is directly from me that I describe to my friends this all the time because I have friends who are also in venture capital, private markets, private equity, and then for hedge funds we're mainly public equity. So there's slight difference there in liquid assets, stocks you can trade, and private investments, right? I describe this very simply in this analogy. I'm quite proud of the analogy. It's just a very simple sport one. Private market investing is kind of like golf or kind of like surfing, whatever it is. That's a little bit higher barrier to entry. The first time you hit, it's really hard to hit the ball, and like it takes a while for better, so people think it's a hard sport. Public markets investing like what we do, stock picking and investing across tradable public liquid names. It's like football, soccer. Football is in the global term, soccer in the States. Everybody who has a foot can kick it. No barrier to entry to soccer. You can play on a beach in Brazil. You can grow up in Argentina or anywhere you can play it. Female, male, doesn't matter. But there's only one Lionel Messi. And he's 5'6", slightly overweight, if you will. He's definitely in great shape, but he looks like he's a little bit over. Why is there only one Lionel Messi? Because public markets investing is just like soccer. It's a very low barrier to entry, but to be a master at it takes years of dedication, compounding hard work, and a touch of genius too. Messi has that, and there's some people who is a little bit more talented that way to sort of do that. So I think public markets investing is not for everybody, and the goal is generally have an advisor that's good to do that for you, or having the proper passive investment vehicles that Jack Bogle built from the 90s till now, and Buffett shouted out to him as one of his heroes to build that accessible for everyday investors to grow with the economy. So I think the idea is to work on something you enjoy for people who have other professions to deal with that, to be best at the daily operations and invest on the side, grow with the whole economy. And for your question specifically for the professional investors, you were talking about for us, how do we deal with the emotional up and down with the markets when we manage portfolios? The personal journey, probably you are going to find your own way. Probably it's going to be the things that you do. It's going to be generally, your fitness routine, your family time, all those things. They come in different orders, and they're very important for your mental stability, mental health. But the most important thing is you have to look at the underlying rationale of why do you own the stock to begin in the first place. So back to first principle. If it's because somebody else is going to pay more for it, then when it drops, it's a bit of a problem. If it's based off, I go on Reddit and somebody else says, 1,500 of us, we each going to put in $1,500, and we're a Reddit mafia, let's just go buy this thing and pop this thing open.
Yeah.
Oh, baby, that sucker's going up. Like, that sucker's going up. Is the big, again, another Peter Lynch quote. He said, the worst rationale he's heard over time, it's always, Peter, that sucker's going up. That's why I'm buying it. I heard it on a bus. Like, that can't withstand volatility. But if I know, for Buffett again, I don't recommend this for health reasons, but, as an avid soft drink consumer, and he's like, Coca-Cola has a moat around the globe. He's like, Coca-Cola is the one. Then, or Amex we talk about, right? It has a special prestige for American cars and things like that. So if you have a conviction in the business and the right people running the business, they are actually treating like the owner of the business, then once you get, again, the 3 Ps, product, people, price, when you have those things in place, go back to the basics and be like, this just, especially going down on something you like, you should be excited. It's generally opportunity. And generally, for the last week's crash and things like that, it to me, it was more like a correction that I look at as de-risking. Let's say if I like something at 700, I think the intrinsic value is 550. I bought it at 80. Now it's compounded a lot. When it goes from 700 now corrects to 550, how I think is that now it's de-risking my portfolio a little bit for me. Now the further downside, now this is that equilibrium, the further downside for me can be adding opportunity, as long as the business fundamentals don't change. So most of the days, and this is an important thought to sort of conclude on this particular topic here, is I spend most days, like this morning, even before we sort of started, I was reading your notes, but also on another, I think I mentioned his blog a lot, right? The Mostly Borrowed Ideas. On his blog, I was reading about how he thinks this AI agent of this intermediate platform effect of does Amazon matter? Does the UI matter anymore? Do the DoorDash matter? UI matter if people just gonna have an agent to book for them and stuff. So I think I spend more time thinking about are the business is going to change? If that's going to change, then the enterprise value for a certain business might go to zero. Then I shouldn't own them. That's real risk in the long run. So I don't tend to look at price movement as risk, but I think about who's going to disrupt this business, that type of thing. Or does Tesla have a moat in the electric car market? Or is Gen Z's everybody use Snapchat and TikTok, so Meta has no place anymore? Like, is that or does ChatGPT competes against market thinks very differently about Google these days than 2 years ago? Right now, it's up a lot. Before, people think Google is going to be having the innovative dilemma, and then ChatGPT is going to disrupt them. So I think about how this business is going to play out. Those are real risks, and those I actually think are underappreciated risk. People don't nearly pay too much attention to that. I think of those as horrendous risks that can happen to a portfolio holding versus sort of just the price movement down 18% for a news that's not related, if that makes sense.
Sure.